Hi, I'm Katya, Finder's life insurance writer. One of the questions I get all the time from readers is, can I take out a life insurance policy on someone else? The answer is yes. You can buy a policy for anyone, whether they're related to you or not. But you need to do two things before you do. The first is prove an insurable interest. In plain English, this means that you'd suffer financially if the person you want to insure died unexpectedly. If you can prove that you rely on that person to keep you afloat financially, or you wouldn't be able to pay off their debts, your insurance company is more likely to issue a policy. Since debt and final expenses, like medical bills and funeral costs, are often passed on to the next of kin, family members usually don't have a problem proving insurable interest. The second thing you'll need to do is to get that person's consent. You can't buy life insurance for someone else without their knowledge. They have to approve and sign off on the policy, and we'll talk about that more in a minute. The process is pretty similar to buying a policy for yourself. Step 1, figure out how much coverage you need. Let's say you're buying a policy for your parent. Start by adding up their assets, such as a home, outstanding debts, like a mortgage or a credit card, and their financial obligations. In other words, what does your parent pay for? This could include everyday living expenses, such as rent, groceries, bills, and car insurance. Once you've done the math, aim to take out a policy to match. So if you add up all of those things and the number comes out to $500,000, buy a $500,000 life insurance policy. If your parent is still in the workforce, there's another way to crunch the numbers. Take their salary, multiply it by 5 or 10, and buy a matching policy. For example, if your parent earns $50,000 a year, you could opt for a $250,000 or a $500,000 policy. Step 2, choose a policy type. There are 3 main types of policies. Term life insurance is the cheapest and most popular policy. It lasts a set period of time, like 10, 15, or 20 years, and pays out a death benefit if the person dies during the term. The premiums stay the same, so you know exactly how much you'll pay each month to maintain the policy. Permanent life insurance is a life insurance policy and an investment product rolled into one. It offers lifelong coverage and builds cash value over time. Depending on the policy, the cash value grows at either a fixed or a variable interest rate. As the owner of the policy, you'll have control of the cash value. Once you've accumulated enough, you can start borrowing against the policy, and the loans are tax-free. Finally, guaranteed issue life insurance might be a good fit if the person you want to insure is in poor health or doesn't want to take a medical exam. With this policy, approval is guaranteed, no questions asked. But since the insurance company has no information about the person they're insuring, these policies are expensive, and you can usually only buy up to $10,000 of coverage. Step 3, get quotes from a range of insurers. Now that you know what policy to buy, shop around. Premiums can vary wildly between insurance companies, especially for people with pre-existing health conditions. To make sure you're getting the best possible coverage for the lowest price, compare quotes from a handful of insurers. You can also work with a broker to source quotes on your behalf. Step 4, apply for the policy. Once you've narrowed down your options to one, it's time to apply for the policy. Life insurance applications are legal documents, so every detail needs to be accurate. They ask for sensitive personal information and medical histories, so you may want to leave this step to the person you're insuring and help out if need be. As the owner of the policy, you'll need to choose a beneficiary, which will probably be yourself. You can also name multiple beneficiaries and allocate a percentage of the payout to each. Unless you choose a guaranteed issue policy, the person you're insuring will then need to take a medical exam. A nurse will visit their home or an office at a scheduled time and conduct a basic physical. They'll also run a few tests, including a blood and a urine test. Step 5, sign the policy document. If the insurance company approves the policy, you'll get a contract to review. This will lay out the final premium and the terms of the policy, so you and the person you're insuring should read the fine print carefully. If you both accept the terms and conditions, Sign the contract and choose a payment method. The policy will go into effect on the date listed on the document. To recap, you can take out a policy on someone else, as long as you have permission and an insurable interest. Just be sure to compare policies to get the best rate, which you can do at finder.com. Thanks for watching.